And then along these lines, looking at option-adjusted spreads. Spreads, as they widen, indicate just more perception of risk or more of an expectation of risk, perhaps default risk. And you can see here over the past year, and this is through early April of 2024, it hit a peak. So spreads have widened quite significantly. And we like that. We like that because we've been waiting for this to happen. And if you've been watching other videos of mine or reading some of my Forbes articles, I've been talking about this, which is when yields or spreads are highly, highly compressed like this. This is an indication that there isn't much risk perception in the marketplace, which means you're not going to have any of this risk priced into bonds, which means bonds will tend to be a little bit more expensive, which means yields will tend to be a little bit lower. So this past week, last week, we were actually able to go into the market and buy yields at some pretty decent rates, over 7.5%. And like I mentioned before, when the 2-year is now below 4% in the U.S. Government bonds, that starts to be very attractive, starts to look very interesting. And the average maturity on these high yield bonds in the U.S. market is around 3.5 years, 3.2 years.